everybody, my name is Ty Bernicke, and today I'm going to be giving you your monthly market update for October. And I'm going to specifically talk about some deteriorating conditions within the economy as it applies to a lot of talk about a soft landing, cracks forming with the consumer, and bank lending tightening. So to start off, a soft landing is the media's way of saying, hey, we might go into recession, but it shouldn't be that bad of a recession. And anytime you see a number of media outlets talking about the soft landing, historically, recessions have followed that. So these little dark lines that you see right here are when there's a big spike in the major media outlets talking about a soft landing. The gray area, it represents recessions. So back in 2000, big spike in talk about soft landing, a recession followed. 2008, with the financial crisis, there was another big spike in this talk about soft landing, a recession followed. Today, there's been a big spike in the number of major media outlets talking about a soft landing. And if history is any indicator of what the future has to hold, we might have a recession coming down the pipeline. So it's one thing that we've been keeping an eye on. In addition to that, if you look at the consumer pre-pandemic and break up the general consumer out there in the United States by income household, you can see that the top 20% is represented by this yellow line. The pink line represents the middle 40% of income earners in the United States. The black line represents the bottom 40% of households. Now, going back to 2020, the amount of cash or extra earnings that people had in their bank accounts was at this level pre-pandemic. And you can see for every single income group that extra cash they had on hand, it actually increased for a period of time. But lately it's been decreasing for every group. In fact, the middle 40% and the bottom 40% are actually at a lower point than they were prior to the pandemic actually hitting. The top 20% still have a higher amount in cash than when the pandemic started, but they're also seeing their extra savings dwindling, which is obviously not a good thing for economic growth because there's not that much free money to spend when there was a bunch of it following the pandemic. In addition to that, another thing that we're seeing is delinquency rates on loans actually increasing to levels for credit card debt and other signs of debt. We're seeing those increase quite a bit higher than pre-pandemic as well. So again, this is a bit of a concern as it applies for economic growth going forward. In addition to that, if you look at this particular graph, the gray areas are represent different recessions we've had over the recent past. The black and yellow lines represents the lending standards that banks have. Small banks are represented by yellow, large and medium-sized banks are represented with the black. Historically speaking, right before recessions have hit in the past, we've seen banks really tighten up their lending standards. And so we saw that back in the 2000, the recession that hit basically starting in 2001, 2002. We saw it in the financial crisis more recently. We saw it during the pandemic, and we're starting to see that line go up to a pretty high level again. And so essentially all four of these different variables that I've been talking about are all signs that we may be headed for a recession, or certainly conditions are deteriorating. The one thing with trying to predict recessions is it's almost impossible to do. You can get any opinion from a lot of different media outlets out there. Some of them are very bearish, others are very bullish. But at the end of the day, it's my job to tell you what we're seeing in the markets. As a result of that, many are asking, so what are you going to do about this from an investment perspective? From an investment perspective, I don't think you should just go out and start selling stocks because historically stocks tend to go down well in advance of a recession hitting and tend to improve before that recession is over. So it's a fruitless endeavor to try to time the stock market and the bond markets based on when a recession is going to hit. It's nearly impossible, and there hasn't been anybody that I'm aware of that has been able to consistently do that in the past. With that said, we are getting more defensive, and the reason we're not getting very defensive is because we had a big downturn in the stock market last year, and part of the reason we had that downturn might have been because investors were thinking that a recession was eventually going to hit. So it may not be a big surprise to a lot of people that invest in stocks and that invest in bonds that a recession is coming. So when it gets here, it's not going to be a big shock. So we are getting more defensive as a firm with the way we manage portfolios, but we don't go all in with any particular strategy because it's very difficult to time these things with any high degree of certainty. So I hope you felt this particular market update was informative. If you have any questions, reach out to your advisors or the people here at Bernicke Wealth Management. And I hope you, once again, I hope you found this useful. Thank you.